Hello, everyone. Good to see you've joined.
Good afternoon.
Hi, Samir.
Hi. I hope I'm audible.
Perfectly, perfectly.
Okay, thanks.
Hear you. I can hear what Gauri is saying without her saying it.
Hello, good evening, sir.
She's been, there are those who keep the show going. I cannot think of the right word. Yeah, but thank you. Yeah.
Anytime, anytime.
Nanda ji, theek hai?
Yes, sir. Good afternoon, sir.
Good afternoon, sir.
House full, 500, more than 500 participants.
Well, that is kind of them. We are grateful to them.
Yes, sir.
Already admitted, or you will admit them?
Already, sir. Already filled. All the total channel is full. Now we are given a second option to join by YouTube.
ठीक है जी. They want to listen to Samir, Gauri, Rohit, and Harpreet.
So should I, sir, call to other speakers? They will be joined shortly.
Yes, please, you can do so. But
Yes, sir. Yes, sir. Okay.
आप कर लें, but we will wait 5 minutes. I'll
Okay.
request everyone to just be patient and give us 5 minutes. Yeah. In the meantime, Nanda ji, आप बात कर लें.
ठीक है. Okay, sir.
Samir, Gauri, if you permit me, I will start in sharp 3-4 minutes because
Your call. I think we are fine anyways.
Certainly, that works.
yeah. As people are there, so it is nice of them to come in time. Yes. The time was to start at 3:45, which is now. Someone has mentioned that it's already over the time, but 3:45 is now. Good afternoon, friends. Welcome to this webinar of PhD on acquisitions and business reconstructions, on tax issues relating to the same. Clearly, the topic is of interest. We already have over 500 participants, and we are grateful for your participation. And there is a second channel which has been opened on YouTube, and the Secretariat is trying to ensure that we are able to accommodate the maximum possible at the webinar.
Namaskar, Chairman Sahab.
Namaskar, Dr. Sharma. I have already started. So, business reconstructions, acquisitions are seeing a surge. M&A is increasing, both domestically and globally. M&A activity may relate to corporates looking to gain on synergy, consolidation, efficiencies, scale, and for increasing competitiveness. The mergers or acquisitions may be friendly, and there may also be hostile bids for acquisition. There are other diverse reasons for business reconstructions, including releasing value, focusing on core competency, sick company revivals, strategic consolidation, etc. M&A may be strategic or financial. In acquisition, one company may acquire another, whereas in merger, two or more companies may be merged. Acquisitions in India may be made by domestic groups or MNCs, foreign funds, PE funds, etc. The deals are of diverse size, ranging from mega to the quite small. As the government promotes Make in India, as India goes forward, there is competitive India as a preferred destination. We may expect to see an increase in business efficiencies, and in restructuring. As such, we are all well served by enhancing our knowledge of this subject. Quite often, it is the tax consequences that determine the way the M&A transaction proceeds. But there are other relevant and important aspects. And perhaps always the most important will be the commercial and financial aspects. And then there are other applicable laws, be it stamp duty, SEBI, company law, and so on. The acquisitions may be of a business as a going concern. There may be acquisition of assets on a lump sum basis or itemized purchase of assets, all of which have profound effects on both the transferor and the transferee and his tax liabilities. In an itemized sale of individual assets, separately identified and valued, the purchaser not only chooses to cherry pick the assets that are subject to the acquisition, but is also at liberty to assume the obligations and liabilities in whole or part of the selling company. In a sale of a company as a going concern on a lump sum basis or a slump sale, all the assets and liabilities of the undertaking of that target company are taken over as distinct from itemized purchase. The acquisition could be of the unit, it could be of the company through its shares, it could even be a combination. There are no fixed rules. It all finally is what is financially, commercially, strategically interesting for the seller and the buyer. But of course, compliance with regulations, and for the moment we are focused on tax, is paramount. We have distinguished speakers. I am extremely fortunate to have them with us. They will throw light on some of the issues and concerns, and aspects that will be discussed are not only the provisions as such, but issues that survive, problems that survive, modifications that are being looked at, and solutions, planning, but foremost compliance. Whether it is merger, demerger, slump sale, we have what is called those that are prescribed merger, demerger, slump sale, or those that are compliant. So there are specific provisions in the Act. If you comply with those prescribed conditions, you are moving towards a tax-neutral merger or demerger or slump sale, or as may be. But if you do not comply, then you are open to consequences. Thus, an in-depth, holistic knowledge is vital. You comply 90%, you leave out something which is even small, and then you have got into troubled waters. So please try and comply holistically. You would see the law as a whole, not only the specific provisions that may apply, such as 219AA or 21B and 50B, etc., but holistically in the scheme of the Act as a whole and various provisions. So what happens to an expense which the transferor company may have initiated, but finally it is in your hands, or there is a bad debt in the transferee out of a sale made by the transferor, or there is remission and cessation of liability in the hands of the transferee out of liability which was incurred by the transferor. What happens to 43B in the hands of the transferee making a payment which he has succeeded to from the transferor? Some clear provisions are there. Some are not free from doubt. And in some, we are seeking clarifications from the government, because it is all in the course of ease of business. Business reconstructions are economy positive, business positive, nation positive. The ease of being able to carry them through to maximize value for all stakeholders is in the best interest of the nation and the business, both. There are provisions that are interesting, which will further come in to be seen. GAR, Section 56, subsection 2, deemed income, Section 50C or 50C capital A, 5627B, it's a whole topic being considered. So these provisions are relevant, and where possible in the short time available in such webinar, the speakers will endeavor to cover them. I at the outset itself, thank you all for being with us. And I thank the speakers. I am also looking forward to listening to them and to sharing thoughts and experiences. I believe you are in for a very interesting afternoon. I wish you a rewarding afternoon today. Thank you very much. We now start our first technical session. And this is on slum sale and demerger. Our speaker is Gauri Puri. I may mention that she has come in as a savior. It was actually supposed to be my co-chair, Pallavi, who has unfortunately fallen sick. And she had already prepared much of her topic. But at very short notice of a few hours, Gauri has stepped in, and I thank her for it. Gauri has immense experience in the subject. I'm certainly looking forward to listening to her. It is always a pleasure to do so. She's a partner in the tax practice of Shardur Amalchand Mangaldas. Neither she nor her firm need any introduction. She has substantial experience in business acquisitions, reconstructions, cross-border transactions, transaction advice, private capital arrangements, and so on. The clients that she has represented are a who's who of global corps. She has been to Harvard. She's admitted to the New York State Bar, non-practicing, and Bar Council of India. Prior to Shardul Amarchand Mangaldas, she was with Lakshmi Kumaran and Shiridharan. Ladies and gentlemen, please welcome Gauri, who will be talking to you about demerger and slum sale.
Thank you so much, Anilji, and thank you so much, PhD. It's always a pleasure to speak at your conferences. Thank you for the opportunity. Will someone be able to share my slides, please?
That's good.
Otherwise, I'm sort of happy to just speak if that's not possible. Monica, Ekansh, would it be possible to share my slides?
I'm sharing, Gauri.
All right, thank you.
Where in doing Ekans is connecting.
Okay, so let me get started while the slides appear on the screen in the interest of time. So slum sales, as you all are aware, are creatures of tax law. This is it's not a commonly used word, and when you think about a slum sale, to me it's a relative concept. You can't understand slum sale without juxtaposing it or comparing it with an itemized asset sale. It's only then when we are truly able to appreciate both the concept of slum sale and the tax consequences which follow in the context of a slum sale. I like to think of them as the Sita Gita of tax. But very quickly, to just sort of give you, to start off, a brief comparison between the two, and then in that context, I will sort of highlight some of the key issues that arise in the context of slum sale. So when you're thinking of transferring a business, there are two ways in which assets can be transferred by the seller to the acquirer. One is by way of an itemized asset sale, wherein typically parties will have the liberty to sort of cherry pick the assets which are required to be sold and purchased. The price for each of these assets will be separately identified in the transaction documentation. On the other hand, a slum sale postulates the transfer of the business as a whole. So the understanding here is that the parties have commercially agreed not to buy certain types of assets alone, but a business activity as a whole, lock, stock, and barrel, such that the there is continuity of business. Once the acquirer has purchased this combination of assets and liabilities, he will be able to carry on that business activity uninterrupted from next day. So therefore, this is where the concept of a business undertaking has sort of developed in the tax law, which envisages in the context of and then the second condition is that the price of each and every asset or liability is not separately identified, but the parties have sort of valued the business on a lump sum basis without looking at its constituents. So that's the conceptual difference between an itemized asset sale and a slump sale. In terms of tax outflow, both of these transactions, when you compare it to a share sale, will always result in two levels of tax. Number one, the company will pay a capital gains tax on the transfer of the asset, or a tax on business profits, if for instance, if it's inventory under an asset sale. And then if those sale proceeds are repatriated to the shareholders, then another additional level of dividend tax has to be paid. Similarly, in a slump sale, you will pay capital gains tax on the transfer of the undertaking. But once the sale proceeds come into the company and you want to repatriate those sale proceeds onto the shareholders, you have to pay another level of tax, which is the dividend tax. Which is why when we're typically, structuring these transactions, you will always see the sell side have more of a tendency to push for a share sale because there is only a single level of tax. Whereas in case of an itemized asset sale or a slump sale, if the intent of the parties is to, sort of exit from the business and repatriate the sale proceeds on to the shareholders, they will be suffering two levels of tax. Now, when you compare the tax outflows between an itemized asset sale and a slump sale, the slump sale, to my mind, has two distinct advantages. And also, a word of caution here, we many times see people, without sort of applying their mind to the nature of the undertaking, concluding that no, slump sale will be more beneficial, but that may not always be the case. So it is a fact-specific exercise. But there are two key advantages. The first, that there's no goods and services tax payable in the case of a slump sale, which is often, if nothing else, a cash flow benefit for the buyer. And so it is always preferred for that reason. Two, that in case of a slump sale, if the business undertaking has been held for a period exceeding 3 years, then the long-term capital gains tax treatment is available. You do not look at the period of holding of the constituent assets, which you would in the case of an itemized asset sale. Another advantage, which I'll tell you comes from my experience, is that if your undertaking is a service undertaking where you're primarily transferring employees or you're primarily transferring contracts, then you will always see a slump sale will be more beneficial, because I find that there is certainty of tax treatment. You know that when you're transferring employees or contracts, the law is not clear whether that income that is realized on the transfer of these kind of assets or obligations or rights are going to be treated as business income or capital gains income. So if you bundle that in a slump sale context, you're clear that you will get a capital gains income. Whereas if you were to transfer employees or if you were to transfer contracts, it's always a gray area whether the tax authorities would treat that income as your ordinary business income or they would treat that as your capital gains income. So in these kind of fact patterns, I find that slump sale gives you that advantage of tax certainty because you understand what that tax treatment will be. The other key aspect when you're comparing these two kind of modes of acquisition are the application of valuation norms. So there are certain, tax fair valuation rules that we have under the tax law, both under the head capital gains and other income. When you're transferring immovable property or when you're transferring shares, the law requires that it has to be transferred either at the tax FMV computed as per Rule 11 UA 11, and then in relation to land, it's required that these assets need to be transferred at least at stamp duty value. Similarly, from the acquirer standpoint, if the asset entailed is immovable property or it involves shares, again, you have to demonstrate that you've paid a price which is over and above the fair market value norms prescribed under the tax rules. So if you see in an itemized asset sale context, both the buyer and the seller have equal pressure to demonstrate that the purchase price of certain kind of assets, which may be being purchased and sold, such as immovable property and shares and security, is above the fair valuation norms. Now, in slab sale, up until recently, we didn't really have any fair valuation norms, and we would argue that typically 50C, 50CA would not apply to an undertaking, even if that undertaking comprised of assets such as shares or immovable property. And so many times it will become common practice to sort of carry out business transfer at the net worth of the undertaking, because it was, there were no rules to sort of check undervaluation. However, very recently, the government has amended the tax rules, pursuant to which tax fair valuation norms also apply to the transfers of a business undertaking. And the rules essentially follow the same methodology as has been prescribed for shares in case of companies, which is basically the net asset value methodology, which in turn also captures any stamp duty value of any immovable property that may be comprised in that undertaking, or the tax FMV of any shares and securities that may be comprised in that undertaking. But there is still an incongruity in that while 50B casts an obligation on the seller to pay capital gains tax at least up to the tax FMV of the undertaking, there is no corresponding requirement on the purchaser to purchase the undertaking at this minimum tax FMV. So here the sell side and the buy side are not very, how do I say it? Their tax interests do not become aligned. And that is still, I would say, a difference between slump sale and an itemized asset sale, at least from the purchaser's perspective. Because if I was to acquire, let's say, land in an asset sale, I would have to pay the, at least the tax FM, which is the stamp duty value of the land. However, if I was to acquire that land as a part of an undertaking, then there is no corresponding rule under 56(2)(10) which sort of checks me for this. And the argument that is often made is that the undertaking is a capital asset distinct from its constituents. So unless there is a specific valuation norm which is applied to the acquirer in the context of an undertaking, these rules should not apply. The other key distinction that arises between both an itemized asset sale and slump sale is in the context of your withholding tax obligations. So as you're aware that under the tax rules, we have a new provision which requires that tax has to be deducted at source on goods which are being purchased. What is the definition of goods? It's not provided under the Income Tax Act, but it could include inventory. I mean, there would be room to argue that maybe includes plant and machinery, etc. So under an itemized asset sale, you may have a requirement to withhold tax on certain kinds of assets. Again, in case of a slump sale, you could argue that the undertaking is a capital asset, it's distinct from its constituents, and maybe in that sense, there may not be an obligation to withhold tax under 194Q. Having said that, this is obviously an evolving position, and the provision is very, very new. The other point that I sort of want to make here is regarding immovable property. So if you're buying immovable property on an itemized asset sale, you have to deduct TDS, right? The question is, do I have to deduct TDS even in the context of a slump sale? And practically the answer is yes, even though that you could argue that that is a business undertaking that you're acquiring and that it is not an immovable property being acquired on a standalone basis. Practically, in my experience, they will not do the registry until and unless you have shown that TDS has been deducted. So this is a very small sort of practical nuance, which flows more from the fact that you want the land registered in your name and you want to, carry out all your title related formalities rather than, purely emanating from tax laws. The next question is with respect to 281. So as you're aware, under the Indian income tax laws, if a buyer purchases any asset pending any tax, proceedings or demands against the seller, then the tax authorities have the power to declare that transaction void unless A, prior permission has been sought from the tax office, or B, that the buyer in a proceeding is able to show that he's a bona fide purchaser of value. Now, often a question arises that, okay, we understand that in an asset sale, if the list of assets that I'm acquiring falls under the 281 exhaustive list of assets, then yes, maybe I'm required to obtain this 281 permission, or at least take protection in the transaction documentation in forms of, a status report from a tax advisor, or for instance, an indemnity. But what happens in case of a slump sale? Again, you go back to the same question, that for purposes of these sections, do you see or do you argue that the slump sale is an undertaking which is not specifically referred into the definition of assets under 281, or do you say no, we must take the 281 certificate and protection? And generally, again, the market practice here is that the purchaser will always be conservative. I don't think the purchaser wants to test this argument out in a court of law. Therefore, the practice is that yes, you would assume that the tax authorities could also invoke 281 in the context of slump sale, because you always, as an acquirer, want to err on the side of caution when you're thinking about transaction documentation. And then the last question pertains to successor liability. So under the Income Tax Act, we have section 170, which essentially states that if a person succeeds to the business of the other, and for some reason their taxes cannot be recovered from the seller, or the seller cannot be found, then in those circumstances, tax authorities can recover the taxes of the seller for the tax year in which the transfer takes place and the year prior to that from the acquirer as the successor. So this is what we loosely refer to as successor liability. Again, there are two requirements here. One is that you must be a successor of a business, and two, that the powers of tax authority to recover taxes of the seller from the buyer pertain to a particular period, right? It can't be all the historical taxes of the seller. Now, the key question is that, does this provision apply in the context of slump sales? And the answer to that is that yes, it could. It's not only referring to successor in the context of, for example, you have a LLP succeeding to a company, or a proprietorship converting into a company, and then, the company becomes a successor of the proprietorship. It could also occur in these business transfer type of cases. And therefore, it is again common market practice that the transaction documentation should cover the purchaser, for any successor liability it carries. In the context of an itemized asset sale, however, it's arguable that, that is not a buyer succeeding to the business of the seller, and therefore section 170 should not apply. But here as well, if the transaction is structured in such a way that the asset sale essentially results in the transfer of the business to the buyer, and the only difference is that in this case, you have identified the values of each and every asset being transferred, then again, as an acquirer, you should err on the side of caution and cover your successor liability risk here as well. Next slide, please. Can we move on to the, yeah. So I think with this, I'll just, very briefly reflect on some common issues that we've experienced in the context of slump sale. I think the first issue, which has been maybe discussed to death, but at the same time, it remains evergreen, emerges in every transaction, is it important to transfer each and every asset or liability of the business undertaking to meet the test of a slump sale? Or is it okay if we leave out a particular asset or a particular liability? Now, there is no straitjacket answer to that. I think there are enough decisions which say that it's not necessary that you need to transfer every asset or every liability to meet the business undertaking definition. What is key is that you are transferring an independent business activity, such that if tomorrow the buyer steps in the shoes of the seller, he will be able to run that business on a going concern basis. Now, whether or not leaving out a particular asset or a particular liability is going to impact your classification as an undertaking is a smell test that has to be performed, by the tax advisors on the deal. If that asset or liability is not integral to the functioning of the business, there's of course a view may be taken that just because some ancillary items have been left out, it does not mean that the transaction would not meet the slump sale test. However, if it is like for example, sometimes we get questions like, can we leave out all employees? How can you run a business without employees? It's not possible. So if that asset or that liability is so integrated or it's so embedded in the business, in those situations, yes, this would become a problem. The second key issue that often arises is that you'll always see that when the buyer and seller will agree to a purchase price for the business, right? And there will be a time between signing and closing where certain working capital adjustments will have to be carried out, because in the gap of three months or 4 months or whatever it has taken to finalize the deal, there has been a change in the numbers because business has to go on in the interim. And so the question is that the working capital adjustments will often refer to certain kind of assets, and they will obviously refer to certain kind of liabilities, because ultimately when you're valuing a business, no matter what the tax rules say that it has to be done on a lump sum basis, a business is nothing but an aggregation of the various assets and liabilities that it comprises of. So does putting a clause on the working capital adjustments negate the concept of a slump sale? Because now you may have referred to certain values of assets or values of liabilities. And I think that it is very important. Things become important. That how is this working capital adjustment being reflected in the document, right? If there is a subtler way to do it rather than really calling out every asset and liability, I think that is a key that any tax advisor on the D should look at. Two, what is important is that you have to look at the substance, right? The idea of working capital adjustment does not take away from the fact that commercially and for all purposes, there is a business which is being acquired and parties are valuing the business as a whole. It's only adjustment which has to be made because of commercial considerations, and hence it should not take away from the from the classification as a slump sale. The third key issue that arises is in the context of allocation of value for payment of taxes. Now, the tax rule very clearly says that if you have to pay stamp duty, and for that purpose you have identified the price of certain assets within the within the undertaking, that will again not deprive the undertaking from the classification or deprive the transaction from its classification as a slump sale. So while the stamp duty part is fairly settled and everybody is aware of it, a common issue that will also arise is that when you have to deduct TDS on the movable property, because a registrar is not going to register the transfer of property without you having deducted TDS, you will be allocating a value to the immovable property as well. So does that take away from the concept of slump sale? And in our view, again, that should not, because the rule is very clear that if the sole purpose of identifying or ascribing value to any specific asset is only to facilitate the payment of ancillary taxes or to do TDS compliances, that should not again result in the transaction not qualifying as a slump sale. Again, an interesting issue that also arises is that many a times we will see that for purposes, and this is not only just in the context of the valuation tax FMV requirements for slump sale, but it's also like a bigger question which arises when you're applying 56-10 or you're applying 50 CA for valuing shares and securities, is that what do you do with because the NAV formula requires you or uses the word immovable property for purposes of value, for purposes of substituting the cost of acquisition of the moved property with the stamp duty value. Does this also cover leasehold interests? Many a times land is held in the company, not on a freehold basis, but it's a lease which is given for 99 years, or it's a lease which is being given, for let's say 51 years or whatever that time period may be. But these are long duration leases where the intent is, of course, to give the lessee almost all rights in the property akin to an owner. And in these contexts, there are certain tribunal rulings which say that because you are not the owner of the land, you should not be substituting the stamp duty value for leasehold interest while you're determining the 11, while you're applying these provisions, which essentially apply to land and building. But here, I think there is sort of room for caution. I think this is still law in evolution. When you have a 99-year lease, it is possible that the tax authorities come back and say that no, because you are for all purposes the owner of this land, this is immovable property. It's immovable property is understood in a very wide sense under the Income Tax Act, and therefore for these kind of assets also, when you're applying Rule 11 UAE or you're applying Rule 11 UA, or for any provision that pertains to movable property such as 50C, you should even consider these leasehold interests. So again, it'll be interesting to see how the law evolves. Next slide, please. So with this, I'll quickly move to demergers. So again, demergers is recognized, of course, under the company's law, where you can sort of demerge certain, assets and liabilities, or transfer certain assets and liabilities pursuant to a court-approved scheme. But it is, I would say, a term of art under the Income Tax Act, because the Income Tax Act defines demerger very specifically, and then it accords tax neutral treatment to the parties who are involved in the process of the demerger. So very quickly, I'm sure everyone's aware, but again, taking a step back and discussing what does a demerger really mean. So demerger is often used when you're trying to sort of, restructure your business and carve out a particular business onto another corporate entity, because it brings synergies into business, or it sort of streamlines the manner in which a group wants to operate. And if the tax policy sort of understands that it's important to facilitate these kinds of corporate restructurings, because they help in unlocking or enhancing, value for the business community. So for purposes of extending tax neutral treatment, certain conditions have been set out under Section 219AA of the Income Tax Act, which read as follows. So that all assets, first of all, there has to be a business undertaking, which is separately identified. We just discussed what a business undertaking was. All assets and liabilities of that undertaking have to be transferred to the resulting entity on a going concern basis. Now, please note that while in the case of a slump sale, we've discussed how you could leave behind certain assets or liabilities, but the conditions for 290 say that all assets and liabilities of the undertaking should be transferred from the transferor company to the resulting entity. Second requirement essentially is that 75% of the shareholders of the demerged company should become, shareholders in the resulting entity, and they should be getting shares on a proportionate basis. And this condition, globally across countries, is what they call as a continuity of interest condition. At Staxo, I'm facilitating this transaction on a tax neutral basis because I recognize that the idea is not to realize the value or realize the gains, but the idea is to just restructure the business. You continue to own the same business such that, you can operate more efficiently. Now, next slide, please. So we've seen, demergers being used very often, in the, both genuinely in the business context, and second, because there are only few provisions in our tax laws which provide tax neutral treatment. Often these are used for purposes of taking tax benefits, or for purposes, of carrying forward tax losses. And I have a case study for you here. So as you're aware that in case of an amalgamation, tax losses cannot be carried over to the transferee entity, unless it meets certain conditions. And the conditions are fairly stringent. You have to, first of all, be an industrial undertaking, then there are certain requirements that have to be made post amalgamation, etc. But many a times you'll see half of the kind of businesses don't meet the industrial undertaking definition. And for that very reason, tax losses cannot move from one company to the other pursuant to an amalgamation. However, if you see the definition of a demerger, in the context of a demerger, Section 72A says that any losses that relate to that business undertaking can be taken over by the transferee company, right? So in comparison to an amalgamation, to be able to carry forward the losses of in a demerger, there is actually no condition other than the fact that the losses should be relating to that demerged undertaking. So one sort of common structure that often comes up and I have for you here is that let's say you have company A and company B that belong to the same promoter group. And company A has significant tax losses. Company B is a high profit company. Company A essentially carries on, let's say, one business. Both company A and B don't meet the industrial undertaking definition. So if today company A was to merge into company B, then company B would not be able to carry forward those tax losses because Section 72A conditions would not be met. So what company A decides to do is it decides to demerge the undertaking into company B and take the carry forward losses onto company B. Key question arises is that is this permitted? Of course, you can do it. Nobody stops you from doing it. But will the tax authorities allow you the benefit of tax losses in company B or not is a question mark. One key issue that arises is that what I'm trying to do here is I'm trying to disguise a merger as a demerger because company A is a shell after I've demerged the business undertaking. So for purposes of demerger, effectively, maybe what you also need to demonstrate is not only that what has gone into company B is a business undertaking, but there is something residual in company A, which did not relate to that undertaking. And commercially, it made sense for you to demerge this undertaking and not merge it. That is to say that the sole purpose of this transaction was not only carrying forward the tax losses of company A to company B. As you're aware, again, we are now living in a very, very different sort of tax world. Anti-avoidance rules are not only prevalent internationally, but we are living in the world of general anti-avoidance rules. And I'll discuss with you, later towards this presentation, how even the approach of the NCLT and the government in the context of using schemes solely and exclusively for tax purposes has undergone a sea change after the Companies Act 2013. With this, I'll move on to my next case study. So this is again a very sort of a classic query which comes now and again. So here I have on my slide a holding company. Okay, it's exclusively a holding company and it has investments in 3 different categories of businesses. So here in my example, let's say there's real estate, there's manufacturing, and then there is cement. If today the holding company wants to, let's say, transfer the shares of the manufacturing investments onto another company. If it were to do so through a simple share transfer, the tax costs would be very high for the simple reason that now we have Section 56(2)(10) and Section 50CA under the Income Tax Act. So there has to be a minimum value, right? And let's assume that this is basically a group restructuring exercise, pursuant to which Holdco wants to transfer the shares of manufacturing, investments into another group company. A simple share transfer will entail a tax outflow. However, if Holdco was to classify its investments in the manufacturing vertical as an investment undertaking and then receive shares in its group company, then it could argue that the transaction is tax neutral because, because it qualifies as a demergers under Section 219AA. One key question that again is a classic question and I still feel is never really truly answered is that can investments or shareholdings in, let's say, even in a particular segment of category of business classify as a business undertaking? So there have been precedents where this has occurred and parties have been able to justify that, look, these are strategic investments. We have, people managing each of these verticals separately. For example, for real estate, we have a separate investment management team. For manufacturing, we have separate for cement, and therefore we are carrying out this investment activity in organized fashion. But then there is another school of thought which says, look, when you think about a business necessarily requires a business operation. A passive investment activity is not a business, so to speak. A business requires employees, revenue streams, etc. Where is that occurring in a situation when you're holding passive investments? So be it that you're holding it in a particular segment. And I think that this sort of controversy reached its climax in the Grasim case, which was recently decided by the Income Tax Appellate Tribunal. So in this case, we had Aditya Birla, which had sort of demerged I think a particular business with certain investments that related to that business. And the tax authorities denied that demerger tax neutral treatment on the pretext that the transfer of investment pursuant to a demerger fails the business undertaking test. Therefore, the shares that were issued by the demerged entity to the by the resulting entity to the shareholders of the demerged entity were classified as dividends. And this, of course, later on, if you look at the SEBI disclosures, it seems that the tax department then tried to levy taxes at two levels. First, capital gains tax on the transfer of the investment from the demerged entity to the resulting entity, and then a dividend tax, because the exemption on the issuance of shares by the resulting company to the shareholders of the demerged company from the definition of dividends is only applicable in case of demergers, tax neutral demergers. And so they tried to put a second level of tax, which was a dividend, in the hands of the shareholders. And I think at that point, DDT was prevalent. So this, of course, became a huge tax demand. But recently, the Income Tax Appellate Tribunal has ruled in favor of the taxpayer. But I want to sort of put in a word of caution here, because the tribunal has painstakingly analyzed the facts, and it was heard that it was not that it was a pure investment alone which was demerged. There was actually an operational business, a full-fledged operational business with employees, with operations, with revenue stream, and the investment was considered to be a part of that business because it had strategic alignment, and it was on that basis that the transfer of this investment pursuant to a demerger was seen as a transfer of a business undertaking. With this, I just will conclude, with my last slide, and I know that this may be discussed as we going on forward, is that, when you think about demergers and how they can facilitate business reconstructions, what kind of sort of flexibility it offers companies and taxpayers to use these provisions to achieve, some of their objectives. There has been a big shift from what the law was under the Companies Act 1956 to what the practice and law is now under the NCLT regime, and we need to be mindful of this. So look, previously the notice would go to the RD. The RD would then forward it to the tax department. All objections and communication was routed through the tax office. We had rulings which said that the tax department didn't have locus standi to sort of intervene in a scheme. There were many times High Court orders were interpreted to be final authority on tax matters. So if the High Court was sanctioning the scheme, it was many times thought that it's not open for the tax department to question that. Now, all of this has significantly changed under the current regime, where the tax department has direct representation. I think the notice goes to them after the first motion, where the tax department is given an opportunity to put on record whatever issues they feel, and more often than not, they will highlight that maybe there is some tax abuse which is underlying the scheme, or there is some tax avoidance motive, and the applicant company will have to sort of satisfy the NCLT as well as the tax department and file a proper response. NCLT has again become more cautious on tax matters. if you see, there has been cases like Gab's investment, Panasonic, where the NCLT has sort of gone into the nitty-gritties of those tax objections being raised by the tax department. Most schemes will now also include, orders passed will also include that, this is that no matter the fact that the scheme is being approved by the NCLT, the tax department has the right to be able to sort of assess the income in the manner that they would like. And I think the final really takeaway is it's GAR, right? The clarifications that came out from the government when general anti-avoidance rules were also presented was that if the NCLT has gone into, or the high courts have gone into analyzing the arguments of the tax department and have given a reason order, then in those situations, yes, you could say that GAR should not be invoked. But if those objections were never really discussed, then even though your scheme may have been approved by the court, it would be open for the tax department to sort of unravel that by invoking GAR later on. So I think the sum and substance of all of this is that the way in which you write your schemes, the way in which you record the commercial rationale in the schemes is very, very important to make sure that it withstands tax scrutiny and that you're able to substantiate that the primary purpose of carrying out a demerger or even amalgamation for that matter is not tax motivated. Thank you so much.
Thank you, Gauri. That was brilliant. Nobody will imagine that this has been done at notice of a few hours and that you were a savior, not the principal speaker to start with. At least I cannot imagine that that is what happened. Thank you.
Thank you so much. Very kind.
You've covered the law the way it is, the lay of the provisions, practical aspects, and even what is likely to emerge going forward, and where the concerns continue to be in whatever substantial measure was possible in the given time. Your last slide, as you rightly predicted, will be continued by Harpreet, because he's talking about those aspects on recent developments in business reorganizations through the decisions of the courts, and how some are saying, yes, this is okay, some are saying, no, this is not okay, on somewhat similar facts. But I will not preempt him. I will let him talk about what is his subject. Some little bit on slump sale and demerger, just to touch it. She did say that there are various judgments that if you do not transfer all the assets, then you may still be what we call a tax compliant demerger, so as to make it tax neutral. Now, or a slump sale, so to say. So these provisions are there. And if you wish to note, there are decisions in Triune projects, which is Delhi High Court, TRIUNE, Triune projects, Delhi High Court. Some assets were excluded, but they still said, no, you are an eligible tax compliant transaction in this matter. There were bad debts or amounts to be written off, and it just did not make any good sense. Rather, it would cause needless concern if those were to be taken over. Just two assets not transferred, Calcutta High Court, ExxonMobil, again, non-transfer of some assets, though all the principal assets were transferred, but it is not that all were transferred and one was still eligible. Summit Securities for negative net worth in a slump sale, how is it to be treated against the consideration and for computation of the capital gains? She did mention the decision, Mumbai. It's a special bench decision. So it has added value. You may note that Summit Securities, there was an issue that if your net worth is negative, is that to be taken as zero or minus as compared to the consideration? But finally, it was decided it is minus. You add that to the consideration, and that is your long-term capital gains. Just one plot of land was not transferred. There was a slump sale. It was taxable under 50B. Mahindra Engineering, Mumbai tribunal, so not transferring one plot of land, it's not just a bad debt or something that was not transferred, and still it would be an eligible prescribed transaction to be tax neutral or slump sale. Premium automobile, she did touch. Here again, it was interesting that the consideration in a slump sale, it was as a going concern on a slump price for assets as a whole, but the consideration in respect of land and building was mentioned. And they said mere mention of such consideration will not take it out of the gamut of a slump sale. Premium automobiles, Bombay High Court. And then Grasim, she has touched, but there is a very interesting part further in Grasim, and she touched that too, that what is an undertaking? Under section 2, subsection 19AA, what is an undertaking under explanation 1? And it is so important that it is worth touching here once more in context of these decisions. Because they said the most important part is that the transaction should relate to one or more undertakings in case of a demerger. So for the purpose of this clause, undertaking shall include any part of an undertaking or a unit or division of an undertaking or a business activity taken as a whole, but does not include individual assets or liabilities, undertaking. So individual assets or liabilities is not there. Part of undertaking, if as a whole, is there, or any combination thereof, not constituting a business activity, that will not comply. So combination of assets and liabilities not constituting business activity is not an undertaking. But what is part of an undertaking is undertaking, a unit or division of an undertaking. So as long as it is a unit or division in itself and it's a business, then it is an undertaking in itself. A business activity taken as a whole is an undertaking. So these are important aspects that have been touched upon and decided. Going concern. So going concern, again for 219AA, a demerger, it has to be a going concern. But KBD Sugar says for purposes of 72 capital A, and those of us who are accountants, and many here are those who understand finance and accounts, going concern does not necessarily mean a running unit. So this is an important decision for 72 capital A, losses, unabsorbed depreciation, KBD Sugars, Karnataka, please, if you wish to note. And once again, because we are in Delhi, Delhi High Court, Indorama Textiles, Delhi High Court, demerger definition, it says not necessary that all properties of undertaking would become the property of the resulting company. What has to be seen is that the essential and integral assets permitted to run as an independent unit, like plant and machinery, have been transferred. But it is not required that all be transferred. So the essential and integral assets which would permit it to be run as an undertaking, that must be transferred. But each and every may not be essential to transfer. Having said that, on a plain reading, it says all assets and liabilities. So I would urge you to try and see, can you ensure that all assets and liabilities are transferred? We now continue on the part which Harpreet will continue on her last slide. And here also, there is a cleavage of view. And let him discuss what is the cleavage. Introducing Harpreet Singh Ajmani, partner of AZB and Partners. He's an advocate on record, Supreme Court. He's a lawyer from the Supreme Court. He's a company secretary. He's a member of various bar associations. He appears in various courts and forums from the Honorable Supreme Court downwards. He's into litigation. So a man who is in the field and sees it, on the court floor himself. And he specializes in all kinds of litigation relating to tax, but also he's a specialist in transfer pricing, APA, advisory, cross-border, and matters relating to transactions. There are various, and structuring of the same, various reported judgments where he has been one of the arguing counsel. These are famous cases, many of them, and one certainly feels a lot of respect for the amount of hard work he must have done at this young age to be involved in so many matters. I'm sure it'll be an interesting session again. Ladies and gentlemen, please welcome Harpreet Ajmani.
Thank you so much, Anil sir, and PhD Chambers for inviting me. Gauri has already laid down the foundation, and Anil ji had already topped up with so many case laws and the missing gaps and the additional parts which are there in terms of amalgamation and nuances on demergers. Now I will slightly touch upon the various judicial precedents which are there and which have been the cornerstones and milestones which require consideration and which have to be kept in mind whenever we go forward for a scheme to be approved before the NCLT and also for taking positions in the tax returns. First, I would like to start with the 72A provision, where carry forward and set off of unabsorbed depreciation and losses is one of the important considerations when we are talking about the amalgamation scheme. In this regard, recently, Chennai bench of tribunal in the case of Roka Bathroom has dealt with one of a very interesting proposition. The proposition there was that the company has approached the NCLT for approving the scheme of amalgamation. And I'll highlight some 3 key dates which would be relevant for considering this judgment. First is that the scheme was filed on 14th of February 2014. Second date would be the appointed date here. It was 1st of April 2013. That is a date anterior, which normally is a practice from when the scheme would be applicable. Third relevant date would be that the date when the order was passed. The scheme was approved on 28th of February 2014. Now, the issue before the tribunal was during the intervening period, that is the date when the amalgamation scheme was filed, just immediately before that, the company, the shareholders of the company were changed. That is on 1st of April 2013, the company which originally had taken over the company and had acquired the 100% shareholding on the appointed day was holding only 26% of shares. It is only thereafter that they have purchased the balance 74%. The issue which was considered by the tribunal was that since on the day when that is the appointed date, the company was only holding 26, the shareholder was only holding 26% of holding, it does not qualify the condition of Section 2(1)(b) of the Income Tax Act, which provides that at least 3/4 of the shareholding should be undertaken, should be held by the shareholders. I'll just read that specific clause 3 of Section 2(1)(b), which provides that shareholders not holding less than 3/4 in value of the shares in the amalgamating company or companies other than the shares held therein immediately before the amalgamation by or by a nominee for the amalgamated company or its subsidiary became shareholders of the amalgamated company by virtue of amalgamation. The tribunal has given a very interesting observation that since in the present case, the court has put the appointed date as 1st of April and admittedly on that date, the holding was less than 3/4. Therefore, the conditions of Section 2(1)(b) are not satisfied. And the tribunal observes that it is settled law that once amalgamation is approved, the amalgamating company ceases to exist. It cannot be regarded as a person under Section 231 of the IT Act, against whom assessment proceedings can be initiated or an order of assessment to be passed. Therefore, appointed date, that is 1st of April 2013, is crucial in this case. As on 31st March 2013, the assessee company had only 26% equity shares in the transferor company, and therefore the provisions of Section 21B read with Section 72A of the Income Tax Act was not complied with. And on this technical ground, the tribunal has disallowed the claim of the assessee under Section 72A. Therefore, we have to be very cautious, although principally I don't agree that the final line of distinction, what has been carved out by the tribunal, would be a subject matter of discussion, and the appeal has already been filed before the High Court, and even the question of law has been admitted. So this is now sub judice before the High Court, but principally, I really think that this would require consideration because there is a technical aspect to it, and only because the appointed date is a date anterior, but the conditions of shareholding has been duly satisfied. Therefore, to my understanding, the tribunal's decision should require some reconsideration. This is one of the judgments, and it is pending in High Court. All the points which were raised before the tribunal are the questions have been framed on that. The second decision, this is a recent decision of NCLT Delhi bench in the case of Minda TG Rubber Private Limited. In this case, basically the scheme was challenged by the income tax department on multiple facets, which is basically a normal stand what they take, that yes, the substance over form is not satisfied, and the scheme is mainly for the purpose of taking tax advantage. These are the general objections which the department takes. But the additional facet, what NCLT has taken in this case is that since the scheme which was filed before the NCLT does not envisage the relevant compliance clause, that whether the conditions as provided under Section 72A of the Act have been dealt with or not, on that finer ground, the scheme was rejected. So therefore, it is very important that whenever we are filing a scheme before the NCLT, we should duly take into account the income tax provisions also, and we should not keep them sidelined, and all the relevant provisions which would be a subject matter of consideration as far as the going concern or the relevant aspects of restructuring and reorganizations are there, they should be taken into account, so that the scheme should not be dismissed on these technical grounds. In this, the NCLT has observed that since the compliance of sections, the scheme does not envisage that the provisions of 72A have been complied with, therefore the scheme was rejected. And in that context, I'll just read one paragraph. We therefore find that the scheme proposed by the applicant is not compliant with 72A of the Act. Hence, we cannot allow the carry forward and set off of loss and unabsorbed depreciation of transferor company in the transferee company, which is a condition stipulated in the scheme under consideration. However, thereafter, this NCLT order was tested before the NCLAT, and this order was set aside to a limited extent, but the order was approved principally that yes, the condition of 72A has been correctly held by the NCLT is not satisfied. However, one more opportunity was given to the applicant, Minda TG Rubber, that they can again modify the scheme and reapproach the NCLT. But principally, NCLAT has approved the order of NCLT, and only a partial relief was given to the applicant. This is a recent order of 20th April 2023, and it says that although we are of the opinion that since before the NCLT no undertaking in the scheme was given by the appellant in compliance with provisions of Section 72A, the learned tribunal has committed no error in dismissing the application. However, before the appellate tribunal, the said undertaking has been brought on record through its rejoinder. In such view of the matter, we feel it appropriate to dispose of this appeal with an observation that if fresh undertaking to amalgamation scheme in terms of 72A of the IT Act is filed before the NCLT may consider the same and pass appropriate orders expeditiously in accordance with law. So on this finer ground, the matter had to travel through multiple layers before NCLT and then before NCLAT. Therefore, it is very important that when a scheme is finalized, these finer nuances are very well taken care of. The next judgment which I would be touching upon is a recent judgment of Calcutta High Court in the case of Purbanchal Power Company Limited. In this case, again, the assessing officer, while framing the assessment in the case of the amalgamated entity, has invoked section 68 by saying that the scheme was a sham in nature and was just a camouflage and was floated with the sole objective of avoidance of tax. In that background, the learned assessing officer has made the disallowances in the case of Purbanchal Power, that was the assessee. This matter thereafter traveled through CIT appeal route. The learned CIT appeal confirmed, and thereafter the matter has gone to the tribunal. The tribunal noticed that first, as far as the requirement of section 68 is concerned, there are the three basic tests which are now very well settled, is that whether the identity, creditworthiness, and genuineness of the transaction has been demonstrated or not. This was the primary foundation, and whether a scheme in itself could be regarded as a sham, it could be regarded as sham in nature, which was duly approved by High Court, and only at the stage of assessment, whether the assessing officer can now examine that whether the scheme was with a sole objective of tax avoidance. These were the finer nuances before the tribunal, and the larger issue, which although it's debatable and has been a subject matter of a lot of litigation, is whether once a scheme has been approved by High Court or NCLT, what is the scope and jurisdiction of the assessing officer? To what extent the assessing officer can go into examination of the scheme, or he has to restrict to the income tax provisions by taking that what has been approved is sacrosanct, and he has to apply the law as it stood based on the scheme which has been approved by the NCLT. Although this has been subject matter of litigation, but still the learned assessing officers have time and again invoked this provision. One of the earliest decision on this issue has been in the case of Vodafone, where the Gujarat High Court, the learned single judge of the Gujarat High Court, has gone into the scheme where the income tax department has doubted the very sole objective of the amalgamation of multiple entities. The three entities were Vodafone, Idea, and Bharti. There were amalgamation of their passive infrastructure assets, and in that context, the scheme to the level of Vodafone through multiple entities which were there, it was a subject matter before the Gujarat High Court. The learned single judge has examined the scheme, and and thereafter came to a conclusion that no, the scheme is only to avoid the relevant tax obligation. And thereafter, the matter traveled to the division bench. The division bench of Gujarat High Court overruled the learned single judge's order and said that once a scheme has been approved, then there are not much scope of interference by the tax department. Yes, the tax department can examine the applicability of the relevant provisions of the Income Tax Act. That is the subject matter of litigation. That would be the subject matter of assessment in the case of the resultant company. But the scheme in itself cannot be doubted. the scope of the scheme in as far as the erstwhile regime of the 1956 Act, the provisions of amalgamation demergers are concerned under section 391 to 394, or as far as the 2013 Act is concerned, the scope of inquiry by the NCLT is to the extent of the scheme which would be there before them, whereas as far as the scope of inquiry and jurisdiction by the tax authorities has to be focused on the relevant provisions of the Income Tax Act. Once a scheme has been approved, the officers ideally should follow the path, should accept that, and should not try to go behind the scheme. In this background, the Calcutta High Court has approved the decision of tribunal, where the tribunal has rejected the allegations of department that no, the provisions of section 68 cannot be invoked. Second, the Calcutta High Court followed the decision of Vodafone in Gujarat High Court and said that once a scheme has been approved by High Court, then the allegations of the scheme being colorable device cannot be gone into. Thereafter, the decision of Vodafone was confirmed by even the Supreme Court. So the Calcutta High Court has more or less followed that view, but still a lot of litigation is happening on this front. Therefore, this judgment lays a very important part that the assessing officer and department should now at least become consistent that to what extent the scope and the jurisdiction of tax authorities is. The next judgment which I would be dealing with is a recent decision of Delhi High Court in the case of Nalwa Investment Limited. In this case, some very important propositions and conflicting decisions of Supreme Court, or rather the law was put in context in this case. The first issue which was considered by the High Court was whether at the stage of amalgamation, once the amalgamation has been done, what would be the nature of shareholding in the hands of the amalgamating company? What would be the significance of that treatment? If in the books of accounts, if the shares are held as stock in trade or capital asset, would that have a bearing as far as the claim of exemption under section 47 is concerned? This was the first issue which was there before the High Court. Although in this context, since the tribunal has not adjudicated upon it and has straightaway gone to the aspect that whether pursuant to amalgamation, if shares are being allotted, is there any transfer? To answer this question, the High Court has gone into the earlier decisions of Rasikmal Maniklal, which was followed by the tribunal for deciding the issue in favor of the assessee, and also the decision of Grace Collis, which was subsequently followed and the law was discussed. So as far as the first issue is concerned, that whether the claim of stock in trade versus capital asset, is it relevant for the purpose of section 47? The answer, since the tribunal did not adjudicate on this issue, the High Court has set aside this issue and has restored it back on that front. But on the larger issue was whether amalgamation in itself, allotment of shares pursuant to amalgamation could be regarded as transfer. For this proposition, in the case of Rasikmal Maniklal, the Supreme Court was considering the issue that what would be the nature of this kind of transfer, and this transfer was examined only from two perspectives in that case. One was in whether it could be regarded as relinquishment or exchange. So the Supreme Court in Rasikmal said that no, this could not be regarded as relinquishment or exchange because there is no transfer. In essence, there is no mutual transfer of ownership of one thing from one person to another. So this was the basis, but subsequently the Supreme Court has distinguished this decision in the case of Grace Collis, And they said that no, there is one more additional element. The transfer could be in multiple modes. The transfer is not restricted to exchange and relinquishment. We also need to see that whether there is any extinguishment of right in the capital asset, and to what extent, whether this could be regarded as transfer for the purpose of Section 247. In that background, the Supreme Court in Grace Collis case has interpreted that yes, Rasikmal's case is not applicable because the court was only considering only two modes of transfer, not the other modes of transfer. If there is allotment of shares pursuant to a scheme of amalgamation, even that may also be considered as extinguishment of right in capital asset. So in that background, the Delhi High Court has decided the issue against the assessee by saying that yes, there would be a transfer, but since the tribunal has not adjudicated that whether there is a capital asset or stock in trade, therefore we are handicapped. Another interesting proposition, which was also considered as an alternative line of argument, which was put forth by the assessee, was that even if assuming that this is a stock in trade, that the shares are held as stock in trade, its taxability would be governed under Section 28. So from that view of the matter, the Supreme Court, the Delhi High Court has considered two important judgments. One was the case of Vania Silk. In this case, the definition of transfer was considered, and whether the exchange of shares could be considered as realization of security. So in this case, in the case of Vania Silk, the Supreme Court has said that yes, it could not be regarded as realization of security. However, this decision of Vania Silk thereafter came for consideration before a 3-judges bench of Supreme Court in the case of Orient Trading Company. In that judgment, the Supreme Court has overruled its earlier view and said that as far as the transfer of shares would also be covered by under the category of exchange of shares to be treated as the realization of security. And for that matters, the exchange of shares had the difference between the underlying shares and the shares which would be transferred would be chargeable to tax, even in the case of exchange. So the proposition, the alternative line of argument of the assessee was also rejected on this point while following the decision of Supreme Court in Orient's case. However, now the Supreme Court is considering this matter, and even there has been a stay on the judgment of Delhi High Court. This is a much needed relief that there are a lot of lacunas and gray areas which would require consideration, and the apex court has to take a call that whether only allotment of shares pursuant to the exchange and in pursuant to the scheme of amalgamation, whether that could be regarded as transfer or not. That would be a larger issue before the Supreme Court, and that would be taken into account. Since the matter has been posted in regular course, I think it's going to take some time, but we should be very conservative as far as this proposition for now is concerned. Sir, back to you. These were the 4 judgments which I would like to highlight.
Thank you, Harpreet. That was superb. And you told something complex in a clear manner and in a summary form, giving the complete related facts that were relevant. I have a submission to make. Firstly, what emerges is as follows. It is universally accepted and accepted here in our country that business reconstruction is business positive, economy positive. What will be business and economy positive will eventually be tax positive. If business thrives, there will be direct and indirect tax. It is for that purpose, and there are other reasons, continuity and so on. It is for that purpose that in certain conditions, schemes are tax neutral, provided they comply with the given prescribed conditions. So if you have a tax compliant scheme for merger demerger, it is likely that you are going to be tax neutral, at least on the principal aspects. There are other sections and provisions, but that's a separate matter of detail. Capital gains to the extent of the scheme, depreciation, WDV, losses, unabsorbed depreciation. These are some of the more common aspects that come into play. Stock in trade transfer relating to business income. If a business reconstruction is business positive, country positive, economy positive, and that is why the law makes it tax neutral, then that is the first point that must be seen. We must also, and our government has been saying this, and we respect that we must have a position of trust. At first instance, we trust our taxpayers. We trust our businessman. He is there to do business. He will not do something which is inappropriate or incorrect or kill his business. So let's take it that at first instance, generally and the vast majority, there may be some aberrations. Then there are ways to look at the aberration. But generally, what they are doing is positive, for which tax neutrality was created, then please see it to its logical conclusion. Now, the only time you should interfere with such schemes, particularly when they are approved by the prescribed forum, such as NCLT, used to be High Court, under the provisions of Company Act, and then thereafter income tax applies. If it's a bona fide scheme which has been approved, if it wasn't, it would not have been approved. Then go ahead and give the benefits. The fact that I have done a commercial, financial merger, demerger in a tax compliant manner, the fact that it gives me any related small tax advantage, so be it. But eventually, if I thrive, collection will also thrive. And the whole purpose of tax neutrality was to permit me to go ahead. So unless what I have done is sham, collusive, bogus, and that should not be based on suspicion, but on some cogent substantive basis. Unless I have done something where I am amiss in that manner, sham, collusive, bogus, then there should be no interference. Now, what is happening is that the forum is saying, we are approving the scheme, but the tax department may see, is it for tax avoidance and is it tax compliant? Tax compliant is fine. But tax avoidance I take to mean tax avoidance in context of settled principles, such as I should not be doing something which is bogus, collusive, sham. If it's a bona fide transaction and scheme in the interest of business, as per settled principles of how such matters are done for good commercial reason, then let me go ahead and do so. Now, a problem in the field. An assessing officer may or may not know how to judge the bona fides of such scheme once company law tribunal sends it to him. So I would urge and pray that the tax department takes out some instruction, some circular on these matters, so that economy and business positive schemes duly approved by the forum do not run into difficulties or litigation. Because that is not ease of business, that is not positive, that will benefit nobody. No stakeholder will be benefited by that. So training, instruction, circular, it's required and it's capable of being done. Let me give you an example. Trading in shares, is it capital gains or business income? This was an oft repeated issue. So CBDT took out over the years 3 circulars and has helped cure the difficulties, saying follow such and such rules and principles. Something like that can be done now. This needs to be considered the last one. If somebody says you are seeking set off of loss, so I am not going to give you amalgamation. What is to be done? Is the existing company loss making to sink? Is that better for business, for government dues, for stakeholders, for employees? Or should that loss-making company strategically, financially be supported by another merge and everybody gets better and moves forward? The fact that incidentally there is a tax loss that may get some commercially, that institution will continue and survive rather than kill people's dues, kill jobs, kill government collections. So these things have to be seen in the larger picture. And I'm sure that there are people who appreciate these things, and these matters need to be brought to the attention of the authorities, and I'm sure they will give it their best attention. Thank you very much, Harpreet. Very grateful to you for your very fine presentation. My next speaker is Samir Gogia from Deloitte. He is talking about issues in section 56, subsection 2, clause 7b, and related rules, including certain recent circulars and notification, draft rules, applicable rules. And I have gone through his paper. It is extremely interesting. He has applied his mind. He has done thinking out of the box, and he is presenting it in a very clear manner in his PPT and talking about different situations and what would happen. Samir, again, is an extremely well-versed and intelligent tax executive. I have known him for long, been in forums with him for long. He has more than 25 years of post-qualification experience in domestic and international tax, advisory, litigation, compliance, regulatory, principal industries, MNCs, transaction advice, and marquee companies, marquee clients in extremely interesting transactions also. There is a wealth of experience and a very keen and sharp mind. Ladies and gentlemen, Samir Gogia, please.
Thanks, Anil, for the introduction, and a very good evening to all my friends. I hope I'm audible.
Yes, to me at least, yes.
Yeah, okay. Let me share my screen. Yeah, a very good evening, and I think I would like to laud PhD for taking up this issue, which is so current and relevant. And I think we've got only 45 minutes for the seminar. I'm not sure you're going to extend it or not, but it's been too heavy discussion for all my earlier friends who have taken up such an interesting topics. So what I'll try to do, and Rohit to follow, I'll try to finish off it faster than my allotted time, so that Rohit have enough time and audience have enough patience to hear what we are trying to speak on, and this gives some values. So the topic is 56 to 7b, and it's a pretty old section, been in long from 2012 when it was applicable. And believe you me, they called it as an angel taxation. And by the end of my presentation, I believe most of you will not feel it to be an angel by any stretch of imagination. So I'll just pick up certain points, and we have a recent changes in this section, a notification and certain amendment by last Finance Act. So I'll try to cover up more of the recent issues rather than pretty old ones, which have more or less settled, or there are certain litigations happening around that. Briefly touching upon the section which this section talks about, it's applicable for companies in which public are not substantially interested, which means particularly we're looking at private closely held companies. It talks about, it was introduced in Finance Act 2012, effective from 1st of April 2013. It provided that company issue shares to a resident earlier. Now it has been stretched to a non-resident for an amount received in excess of a fair market value of the share, then the said excess portion will be regarded as income of the company and charged to tax under the head income from other sources. The said fair market value is defined as higher of the value arrived on the basis of method prescribed under section rule 11 UA, and it has to be or the value substantiated by the company to the AO, whichever is higher. The word here receives referred in section 5627B has been interpreted to mean it implies two persons, the persons who receive and the person from whom it is received. And it is important that the mere receipt of money is not sufficient. There has to be an income which would attract this section. That need to be seen. The above clause shall not apply to consideration received by a venture capital undertaking or a venture capital company or a venture capital fund. The government has prescribed the specific exclusion for them, and the basic rationale for this section was to curb any black money or attempt to create all these avenues or to stop these avenues where the shares were issued on a premium and the excess was not taxed either in the hand of the issuer or by a payer. Specific cases where 5627B may have an implication, I'll take upon amalgamation and demerger. I think Gauri touched upon certain specific issues with regard to slum sale, amalgamation and demerger. 5627B, now there are cases that will 5627 be applicable on a merger or a demerger. There are arguments both in favor or against. However, if we see there have been certain legal precedents about the applicability and there are litigations around it. You have a Bombay High Court case in case of Sadanand S. Verde. It is possible to contend that the asset received pursuant to amalgamation by an amalgamated company is not in consideration of the shares issued, but by operation of law. So we have a favorable case in case of Sadanand S. Verde. And there are other arguments as well, which talks about that amalgamating company is the amount received, the issue of shares by an amalgamated company is in consideration of extinguishment of shares of the amalgamating company and not for the receipt of assets on amalgamation. So there are certain positive cases as well where they have held that it will not be applicable. However, this is issue which is litigated. The tax authorities may always contend that there is no exception provided for non-applicability of section 5627B on issues of share pursuant to amalgamation or demerger. They may rely on the rule 40BB 5 and 6 of the income tax rule, which provide for the methodology to determine the amount received by amalgamating company doing a buyback of shares that were issued on amalgamation. So tax office may always rely on that argument, and it seems to be a litigative issues. Coming to slum sale and the consideration, applicability of 5627B on slum sale. This will be applicable on slum sale because this is regarding issue. This is for an undertaking, and whenever there is a valuation as per fair market value, amount is discharged. In case the transferee, the undertaking should be regarded as a consideration received for issue of share by the transferee, even though the individual asset and liability of the undertaking would be recorded in the books of account. The transferee on the basis of carrying value of such asset and liability on the books of the transferor. So this will be applicable on case of slum sale. Conversion of debentures and preference share. Definitely 5627B would be applicable on such conversions because there are arguments though that at the time of issue of such preference shares or debenture, 5627B is not applicable because you have to go on the market value of it's only applicable on equity share. However, at the time of conversion, it will be applicable. 5627B will be applicable.
Samir, I'm sorry to disturb you. I don't think your slide is coming on the screen. Is it coming on others? Harpreet, Rohit?
So slide is coming, but it is not moving actually.
I'm still on slide 4.
No. Slide 4. It is your original first slide. The starting slide which is there, the rest are only in the margin. You need to do some setting, please. They are very interesting, your slides. They need, everybody will be happy to see them.
No. Rohit, is it similar you are viewing, or are you able
Yeah,
to?
only the first slide is visible. You probably have to start the this presentation mode, no?
So I'm on a presentation mode only. Let me
Sir,
reshare
I
it.
can share if in case there's a problem.
No. Let me just share it again.
Yeah,
Okay.
just take 2 minutes. No rush. We have time. Take 2 minutes. Yeah.
Okay.
It's very nice what you have made. It will be worth seeing. नहीं तो आप मोनिका लगा दें.
Sir, shall I start?
Just 1 second. Hang on. Just 1 second.
Yes.
Sir,
This
is this visible, sir?
This is better. Just can you increase the font? Otherwise, it's much better. Now it's on the screen. थोड़ा सा font जे आप बढ़ा सकें तो आप please कर दें.
So it's a PDF. I cannot change the font here.
All right. Okay. Okay. Fine. We can see. I can see it now. I hope everybody can.
Monica, I think there's a
Yeah.
so there is a box coming in front of the slide that I cannot share. Let me
So shall I stop sharing?
yeah, just stop sharing.
Okay. Okay.
Is it visible now?
Yeah, it is visible now.
Yes, sir. Yeah, it's visible.
Okay. Thanks, Anil, for pointing out. I think I would have been running past through and people were not able to see.
Take your time, Samit. No rush. Take your time. We have time. Yeah.
Okay. I was on the conversion of debenture into shares and conversion of preference shares into equity share. The said section will be applicable on such conversion. There are two views though, that there is no exception provided in section 5627 for these type of non-applicability. However, there are cases as well based on other view that the legislature intent for introduction of 5627B is to deter the generation and use of unaccounted money, and thus include within scope only such transactions which facilitate conversion of unaccounted money. In case of ordinary transaction of purchase and sale of goods, this again would apply because the profit in case of sale and purchase of such good will already been included in the profit accounted by the other person. So there are arguments both in favor and against, but being there are no specific exclusion, these three cases, there will be a probability that 5627 will be applicable on these three scenarios. Coming to the conversion of partnership firms or a proprietary firm into company, again, the issue of share is pursuant to a statutory vesting of assets and liability of the firm into the company. Even though there is no exception provided for non-applicability of conversion of firm into a company, it may be possible to contend that provision of section 5627B should not apply on such conversion. However, the tax authorities may contend that there is no exception provided again for section 5627B pursuant to such conversion. They may rely on again rule 40BB9 of income tax rule, which provide that methodology to determine the amount received by a company doing a buyback of shares that were issued on conversion. So they may extend that argument on conversion and succession as well, that this should be applicable. I'm moving on to the next slide. I hope this is also visible.
Yes, sir. These are visible.
Okay, thanks. Now I'll come to the changes which has happened in this Finance Act. Finance Act amended this section 5627B The amendment says that the consideration received from a non-resident is brought under the ambit of the clause 57B by removing the phrase being a resident from the said clause. This made the provision applicable for receipt of consideration for issue of share from any person, irrespective of the residency status. I have tried to explain this by an example on my slide, where there has been an investment by a non-resident as well as a resident on a domestic company. The FMV in both the pre-amendment and post-amendment. On the left-hand side, I have kept a pre-amendment scenario. And on the right-hand side, I have tried to include the post-amendment scenario. The FMV of a domestic company, in both the cases are taken as 90. The issue price have been taken as 100 in both the cases. If we see a pre-amendment scenario, the taxable income in the hands of Indian company will be 10, and the tax accordingly taken 25.17 as 3 rupees. However, in case of non-resident, there was no taxation happening. If we see on the right-hand side, post this amendment, this 10 rupees will also be taxed in the hands of the company on account of difference between the FMV and the issue price by the domestic company. And this 3 rupees will be taxed in the hands of the domestic company. So this is broadly this amendment which has happened post this Finance Act. And this is relevant for the current financial year as well. Coming to the notification, which post this amendment, government on May 29th and 30th, 24th May and 26th May, they came up with certain notification. There are two notification 29 and 30, which specifically talked about certain exclusion or certain entities which are out of this purview. There was a notification dated 30th June 2023, which exempted startups, and there was a detailed instruction what all will be excluded. These were excluded from the definition or the applicability of this section. The notification now, there were certain other entities as well. There were government and government related investors which were exempted. There were banks or entities involved in insurance business was also exempted. There were 21 foreign entities, specifically SEBI registered FPI, endowment fund, pension fund, and broad-based pooled investment from these 25 notified countries. Government has notified these 21 countries from where these investment or entities will be exempted through this notification. What need to be seen here is that this notification exempting class of person does not contain the word non-resident. So this is again a food for thought that this notification does it apply to residents as well, which means any banks or entities involved in insurance business in India or a resident are also exempted. One. Second, other banks or entities or banks which are only in insurance business are exempted, because it talks about banks or entities involved in insurance business. Because if we see the Hindi version of this notification, I'll just read out for the benefit of all the audience. It talks about that बीमा कारोबार में लगे हुए बैंक या अस्तित्व जहां ऐसे अस्तित्व देश में लागू बीमा करों के अधीन है जहां पर वह स्थापित या नियमित या निवासी है. Reading through this Hindi version of this notification, it says that banks which are in the insurance business are only exempted. So there are two views possible on this. So that need to be seen how government take up this. It seems that, so based on this notification, which were issued on May, and these are not draft, these are final notification, we assume the government may come up with other clarification as well on these draft notifications. These were certain rules which were notified. These are certain rules which are on draft stage. These were issued end of May, and there was public consultation and notes which were invited for public consultation. They can give them their views on those. So it talks about, what does this rule say? This rule says that there are 5 additional valuation methods which are prescribed. So they have prescribed comparable company method, probable weighted unexpected return method, option pricing method, milestone analysis method, and replacement cost method. What need to be seen here is these are in addition to the two methods which are currently in existence and applicable for residents as well: discounted cash flow or asset-based method. These are currently applicable both for resident and non-resident, and they have notified 5 additional methods for non-residents. The other rule says that this consideration has to be received within 90 days of the issue of shares, which means that they have given a 90 days window where this report can be valid, and the consideration needs to be received within 90 days of that window. They have also given a safe harbor or 10% for the fair market value, which means there can be a 10% variation from the issue price and the valuation, and that's taken as a safe harbor for non-resident investor. What need to be seen is that I'll just take up an example to show what can be a discrepancy in the, because it talks about valuation report date. Suppose a merchant banker determines FMV of the share on 30th April 23. However, the valuation report is dated 7th of June 23. The question is how to interpret the phrase date of valuation report. Should it be observed as 7th June 23 or 30th June 23? Which means extending this to this, will we get 90 days from the date when the valuation was done, which is 30th April, or when the valuation report is issued? Because there might be a error or that need to be rectified, that they have linked it to the valuation report date rather than the valuation of the shares when it was done. So that again need to be seen how government will interpret this 90 days from the valuation report date or the valuation of the shares when it was done by the merchant banker. Additional confusion and compliance when a resident and a non-resident are investing simultaneously. What need to be seen is when there might be a case where the investment can be from a resident or a non-resident, which means two reports, two valuation need to be carried out. Timing has to be different, and methodology will also be different because these 5 additional methods are not applicable for resident. These are only for non-resident. So we may have a different scenarios where there might be a conflict on the valuation as well as how these will be taken up during the assessment and when the consideration is received. I'll take up interplay of FEMA with income tax. What has happened now? Once these rules are notified, these become final. What will happen? If we see, as per the FEMA regulation, the minimum FEMA states minimum value. However, the income tax talks about higher of FMB or what is prescribed. So it talks about maximum value. So the point of differentiation is that FEMA talks about the minimum value that need to be brought in. Secondly, FEMA talks about some international acceptable pricing methodology. However, income tax only prescribes certain 2 earlier and 5 new method of calculation. FEMA talks about report by a merchant banker or an accountant. However, income tax only talks about report by a merchant banker, and we have seen that an accountant has been deleted from the acts, which means there might be a conflict of discussion where the valuation report or the value may be different as far as FEMA is concerned or income tax is concerned. This was not happening earlier before the amendment because non-resident were exempt. They were not being taxed under 56(7)(b). However, we'll see more of these cases where there will be a conflict of pricing as far as FEMA and income tax is concerned. Next comes conversion of convertible instrument. I'll explain this with an example in my next slide, but just to touch upon it, FEMA talks about the price at the time of conversion should not be in any case then be lower than the fair value. And it talks about calculation of fair value at the time of issue of that instrument. However, income tax talks about at the time of conversion. So there might be a timing issue as well as the value issue when you are issuing an instrument or when you are converting that instrument to a share. I'll just take up this easy example to have more clarity on this. If we see FEMA regulation is 2019 talks about in case of a convertible equity instrument, the price or conversion formula of the instrument should be determined upfront at the time of issue of the instrument. And the price at the conversion should not in any case be lower than the fair market value. If we see an example below, FNB at the time of issue as per FEMA valuation is INR 100. This is the price at the time of issue of the instrument. Conversion price should not be lower. However, at the time of conversion, those of this instrument, either be a debenture, be 80. FMB at the time of conversion, as per Rule 11 UA, calculated as per income tax is 80. Now, if we see here is that FMB, which was written, is 80. However, deemed conversion price, which was 100, calculated as per FEMA earlier, we see a taxation of 20 being taxed under Section 50, in spite of the fact FMB being 80. So we have a 5 rupee as tax still happening because of the timing difference between FEMA valuation as well as income tax valuation. I'll just end up my presentation with certain issues which has actually cropped up, and we have tried to analyze what has and also give you some food for thought. The first being that this exemption is provided only to 21 countries, is not blanket exemption. Only certain categories of investors are exempted. And it has to be seen that government has not included certain jurisdiction from which government is getting most of the FDI, be it Singapore, Netherlands, UAE or Mauritius. They have not included those jurisdiction to cover exemption for that entities. That is something to be seen, how government come up or how these countries give a representation to government to include their entities as well. There are new valuation methods that are only for non-resident. These are not for resident at all. So which means that we may have different valuation for a existing company where both we have seen a resident and a non-resident investing. Convertible and non-convertible preference shares, there's no topic to be discussed. They'll remain earlier. What FMV of such instruments shall continue at the price they would fetch if they were sold in open market. That's the position which was earlier as well. There is no provision relating to grandfathering provided in the amendment provision, notification or draft rule. However, the final rule may provide for grandfathering if at all. Applicability of provision in case of partly paid up may be subject matter of litigation, as provision do not apply as part consideration is received before the year end. If we talk about that it was received last year February and the other tranche of payment is received in the current year, do we have a situation where the entire consideration will be taxable? We have certain case law. We have a Chennai tribunal case in case of Archon Chemical Industries, which says that the provision was not applicable at that time. Applicability of the date of notification. So provision do not apply as past consideration was received in the year when provision were not applicable. So we have these litigation also in store where there will be a situation where part consideration was received last year and the entire consideration is received this year. There'll be a different valuation methodology as per section 56.2.10 and 56.2.7b. We have two discrepancies happening also on the calculation of fair market value as per section 56.2.10 and 56.2.7b. We'll have a litigation around that as well. And also if we see whether section 56.2.10 would apply on issue of shares is also a subject matter of litigation, since after the issue of share, the property originates. So there are different wording and applicability where there's 56.2.10 and we have seen litigation around those. However, and also we have to see different tax treaties. If we see a tax treaty with regard to Korea, Germany, Philippines, it provides the right of taxing of other income to the resident country only. So we may use those treaty countries or the investment is coming from those countries and how this income will be exempt because the rights with the resident and they may not be taxed in India. So we can use those treaty to avail the benefit of them getting covered under this clause. Just a thought process that MNCs who are contemplating to have presence in India can evaluate the option of having an LLP in India, since section 56.2.7b is not applicable on LLP. So they may think of investing through an LLP mode. And just the last, I think all the expenses incurred in relation to issuing of such may not be allowed, as these are treated as expenses in capital nature. Just to ending up with a food for thought, there are certain open issues. There are some draft rules. Government is collating all the inputs received from public, and they'll come out with the final rule. However, the notification are still final. We will say more of notification, more of countries being included. Happy to take up question, but I think after Rohit, I think we are already running short of time. Thank you.
Thank you, Samir. It was interesting, and it is a good effort, because much of what you are saying is not really available in public domain, nor it has been much discussed so far. Thank you very much. I appreciate your effort. In all fairness, I need to quickly now go to Rohit, as he has to go for a matter soon after. Rohit Jain is, as you all know, from Vaish Associates. He's again a major in tax matters. He has been a speaker well known to all of us in the city and in the country. He's with Vaish Associates as a senior partner. He litigates in various tax forums and in related matters such as Benami law, BMA, others. And again, from the experience that he has is not only litigation, but advisory, structuring, transaction support, and again, for some of the best domestic and MNC companies. Rohit Jain, please. And he will be talking about amalgamations.
Yeah, thank you, sir. Good evening, all. I'll just take a minute to screen share my presentation. Just taking the help of my colleague. Stop. Stop. I hope my screen is visible now. Yeah, I hope my screen is visible.
Yes, sir, visible.
So I think due to paucity of time, in fact, before I start, thank you PhD for giving me this opportunity, and particularly Anil sir, for again giving me one more opportunity to be part of this PhD seminar on one of the important topics relating to business organization. I'll directly come to my presentation. Broadly, I have divided my presentation into two parts. Initially, what I'll be doing is I'll be very quickly taking you all through the fundamental provisions of amalgamation. And thereafter, I have picked up some around 8-10 case studies, which are basically in the nature of issues, live issues, which you may face on a daily basis on various aspects relating to amalgamation, and try to deal with those issues, the positive sides and the negative side, and what could be the possible, a view which may possibly be taken. Now, coming to my first, part, as we all know, just a, depiction of what the concept of amalgamation is. As we all know, amalgamation is basically, a merger or an amalgam of two or more companies into one company. So there may be various forms of amalgamation where one company amalgamates into another company, or there may be two companies amalgamating into a third company, or it may also be a case where two or more companies amalgamating and forming a new company. So but ultimately the concept is that the everything becomes one. This is different from, of course, the concept of demerger, where the existing entity or the existing entity continues to exist, whereas in case of amalgamation, the amalgamating company ceases to exist, and what remains is ultimately the amalgamated entity. Sorry,
Rohit.
So wherein the amalgamating companies merge. Now, the relevant section is 21B, which, gives a tax neutrality to amalgamations, whereby basically the fundamental concept is that in case of amalgamation, there is no tax involved either at the hands of the companies who are part of the amalgamation, which means the amalgamating company as well as the amalgamated company, as well as in the hands of the shareholders of the amalgamating company as well as the amalgamating company. That's broadly the concept of tax neutrality. To come to the specific sections, 21B, as I said, the only requirement is that all properties and liabilities of the amalgamating company should vest in the amalgamated entity, which obviously is going to happen because amalgamation by its very nature involves the merger of one amalgamating entity into the amalgamated entity. And one important condition is that shareholders holding 3/4 in the value of shares. What basically I have highlighted is at least 3/4 in the value of shares. So it is not the numerical strength of the the shareholders which is relevant. What is relevant is 3/4 in the value of shares. So it may be a case where two shareholders who may be holding 3/4 in the value of shares, if they become the shareholders of the amalgamated entity, despite the fact that there may be hundreds of shareholders who may be holding only 10% of the or maybe 2% or 3% of the shareholding, who may or may not become the shareholders, still it will be a tax neutral amalgamation. So the short point is, the relevant thing to be noticed is that 3/4 in the value of shares of the amalgamating company should become the shareholders, and one important aspect is all the shares which are already held. So in case of the holding and the subsidiary relationship, or a company where the shares are already held in the amalgamating or the amalgamated entity, those shareholding needs to be ignored. Now, this I think I've covered. So basically, one important aspect which needs to be considered in case of amalgamation, and which is an important concept for the tax also, is the concept of appointed date and the effective date. Quite elementary, but I'll just very quickly touch upon this, that appointed date is basically a date on and from which date the assets and liabilities merge of the amalgamating companies into the amalgamated company. From tax perspective, this concept is very important and critical because incomes relating to the amalgamating company post the appointed date becomes the income of the amalgamated entity, and therefore it has to be taxed in the hands of the amalgamated entity and not in the hands of the amalgamating entity. While there may be a difference, or there may be a time interval between the appointed date and the effective date, but during this period, as the courts have explained, the business is continued by the amalgamating entity for and on behalf of the amalgamated entity. So once the effective date happens, we have to we may be required to prepare, depending upon what is the appointed date and the effective date. A taxpayer will have to prepare its revised financial statements in order to take into consideration in the hands of the amalgamated entity the incomes and the losses and the expenses of the amalgamating entity post the appointed date. So therefore, this concept of amalgamating this appointed date is relevant. The other concept is effective date, is which basically is the date on which this scheme becomes effective, when the certified copy of the the NCLT order approving the amalgamation is filed with the ROC. Now, the one important concept to be noticed over here is, as I pointed out, post the appointed date, all assets and liabilities and incomes and expenses belongs to the amalgamated entity, but the amalgamating entities cease to exist in the eyes of law on and from the effective date. So just to give an example, supposingly this appointed date is 1/4/2020 and the effective date is say 1st April 2022. Now income post 1st April 2020 will be taxed in the hands of the amalgamated entity, but for all intents and purposes, the amalgamated entity will cease to exist as a legal entity on and from 1st April 2022. It is not that it ceases to exist from 1st April 2020. This concept is relevant because at times one tends to take a view, one tends to take an argument challenging the assessments on the ground that the assessment has been made in the hands of a non-existent entity. So this is important to understand that the company ceases to exist in the eyes of law on and from the effective date and not from the appointed date. Appointed date is only the date on where the assets and liabilities belongs to the the amalgamated entity. Now these are some of the sections which gives effects to the tax neutrality concept. And for example, 47.4 talks about there being no capital gains in the hands of the amalgamating entity on transfer of assets. 47.7 talks about the exemption being given in the hands of the shareholder, because in the ordinarily course, applying the old principle of the Supreme Court in the case of Grace College, had this tax neutralities provision of 47.7 not been there, technically there was a transfer on the shareholders of the amalgamating company receiving shares of the amalgamated company. So technically there was a transfer. Had it not been for this exemption under section 47.7, there would have been tax implications in the hands of the shareholders. Now moving on, section 32.1 talks about the depreciation being available based on the number of days of usage. Then explanation to section 7 to 43.1 talks about the depreciation to be calculated on the basis of the written down value. 35(d) talks about the expenses of amalgamation being allowable over a period of 5 years, 5 equal installments. I may just point out, in the context of 35(d), there was a recent controversy in the context of allowability of amalgamation expenses. Unfortunately, the Delhi bench of the tribunal in the case of NIT Technologies took a view that in case of amalgamation, the expenses are not allowable under 35(d), and those expenses will be allowed only in the hands of the amalgamating company. So we challenged it before the Delhi High Court, and the Delhi High Court, appreciating the fact that in case of amalgamation, the amalgamating company ceases to exist, then obviously the expenses can only be allowed in the hands of the amalgamated company, and therefore reverse the judgment, which is reported as Coforge Limited, which is reported in ITRs. Now then, these are other provisions which talks about the period of holding of the assets of the amalgamating company being available in the hands of the amalgamated entity. Then these are provisions related to. So ultimately the concept is of tax neutrality, that in case of the amalgamation satisfying the conditions of merger of 2(1)(b), there will be tax neutrality both in the hands of the amalgamating company as well as in the hands of the amalgamated entity, and the shareholders of the amalgamating company as well as the shareholders of the amalgamated entity. Now what I want to deal, and 72, I think Gauri also dealt, and some of my earlier speakers also dealt, which talks about the carry forward of loss or an unobserved depreciation of the amalgamating company in the hands of the amalgamated entity. There are few conditions which are required to be fulfilled in order to give that benefit. Those are tabulated over here. Broadly, the condition is that the losses must relate to a business which must be in existence for 3 years. It must continue to exist for a period of 5 years post the amalgamation, and then the 75% of the book value of the assets continue to be held by the amalgamated entity post the amalgamation. So these are basically the conditions which have been brought into to ensure that the benefit of carry forward of loss and depreciation is available only to a bona fide or a genuine case of amalgamation, and it is not a case where you undertake an amalgamation only for the purpose of taking the benefit of losses of the amalgamating entity and then winding off the business. So these are basically, one may say, some kind of the conditions which have been put into to ensure that only the genuine entities becomes eligible for the benefit of losses and depreciation. Now, meaning of industrial undertaking is given in the section itself, so I'll just put it on the screen and then not repeat it over here. One important recent concept which is has been introduced in the provisions of the Income Tax Act and which probably may have gone unnoticed, is section 170 capital A. As we all know, under the earlier, once a scheme of business organization takes place, usually as a consequence or to give effect to that scheme, usually one is required to, prepare a revised financial statements, revised tax returns, and obviously those tax returns will have to be filed and, subjected to assessment. Now, the difficulty which usually one was used to face earlier was there was no specific provision, permitting the filing of the revised return. And therefore, the issue which used to arose was how, if the supposedly the time for filing the return in order to give effect to the amalgamation or any kind of business reorganization has, expired, how do we file a revised return or the return to give effect to that scheme? What came to the rescue was, depending upon the features of the scheme, if the scheme specifically provided for, filing of the revised return in order to give effect to the scheme, the Supreme Court in Dalmia Power said that the assessing officer will have to take into consideration the revised return, and will have to process that return. But there was no statutory provision as such, permitting taking into consideration, the revised financial statements and the revised to give effect to that scheme. Now, this section 170 capital A has been introduced recently by the Finance Act 2022 with effect from 1/4/2022, which now specifically, in fact, it creates an obligation upon the successor entity to file a modified return. So, but the word which is given is a modified return has to be filed after the scheme is approved, after any business reorganization scheme is approved within 6 months from the date of the order of the NCLT or the High Court or the adjudicating authority. Now, the section further provides is that in case the assessment is ongoing at the time of filing the modified return, the assessing officer at the time of making the final assessment will take into consideration the modified return where the assessment is already over. So in a case where the assessment is already done or assessment is not picked up for scrutiny, there is an obligation on the assessing officer to take into consideration the modified return and determine the income by to give effect to that, shall pass an order giving effect to that scheme. There are some issues which arise in the context of this provision, I will be dealing with it as part of my some of the issues which I have highlighted. So these are, I have mentioned it as case studies, but these are more in the nature of some of the live issues which needs to be considered or debated. The first issue which I have pointed out is supposedly that there is a merger of a company called ABC into PQR, and PQR, apart from say shares, also issues bonds and debentures to the shareholders of ABC Limited. Now, the issue which would arise is whether it will be a tax neutral amalgamation and what is the consequence of the issuance of bonds or debentures. Now, the answer to this, according to us or according to me, would be that because if you see section 47(7), in fact, this B is extra, this is only 47(7). So 47(7) talks about, issuance of only the shares as a result of amalgamation. The law does not permit us to, issue bonds or debentures as a result of amalgamation. And therefore, technically speaking, if the bonds or debentures were to be issued in lieu of the shares of the amalgamating entity, whether it is along with the shares or without the shares being issued, in that situation, technically, there will be a violation of section 47(7), and therefore, the benefit of the exemption in the hands of the shareholders of the amalgamating entity may not be available. So this, I think, our suggestion would be this may be avoided. So there should not be an issuance of bonds or debentures to the shareholders of the amalgamating entity. The second important aspect which I wanted to delve about was whether 72A would prevail over section 79 or it will be vice versa. Now, just to give an example, in the case study 2, supposingly ABC Limited merges with PQR and it has brought forward accumulated losses. Now, as a consequence of the issuance of shares by the amalgamated entity, it may so happen that there may be change in shareholding of more than 551%. As we all know, Section 79 says that if there is a change in shareholding of more than 51% in the hands of the company which incurred losses, then in the year of change in the shareholding, the entity will not be eligible for the benefit of losses because of the prohibition contained in Section 79. Now the issue which arises is, in case of amalgamation, whether 79 will override 72A, and despite 72A specifically permitting the benefit of carry forward losses or depreciation, whether 79 would hit and the losses would not be available. Now, one possible because if we see both the provision uses not with the non-obstantive clause. Now, the issue which would arise is which non-obstantive clause would override, would prevail over the other. One possible and arguable view, which according to us is that in case of amalgamation, what would prevail is Section 72A, which overrides the entire provisions of the Act, and which gives specifically benefit for carry forward of losses and depreciation in the hands of the amalgamated entity, so long as the conditions of Section 72A are satisfied. In fact, if we see, 72A is a specific provision dealing with amalgamation, and a general law principle of interpretation is the specific provision would override the general provision. That is one. Secondly, 72A lays down certain conditions to be fulfilled, and it nowhere refers to the conditions of Section 79 being fulfilled. So and as Anil sir also pointed out initially, the concept of amalgamation and business organization being, the benefit of tax neutrality and benefit of losses being carried forward in the hands of amalgamated entity was basically to incentivize these kind of business restructuring. And therefore, having a holistic view of the entire provisions, the possible and apparently the correct view would be that 72A would prevail over Section 79, and therefore the benefit of losses would be available in the hands of the amalgamated entity, despite the fact that there may be change in shareholding of more than 51%. Now, the next issue which I wanted to touch upon was with regard to, because 72A, as I pointed out, requires certain conditions to be fulfilled. For example, continuity of business for 5 years, the assets being held, 75% of the assets being held. Now, the issue is whether the provision, how do we test the applicability or how do we test the fulfillment of those conditions of 72A? Whether it is to be seen with reference to the appointed date or the effective date. So just to give an example, supposedly the appointed date is 1/4/2022, whereas the effective date is 1/4/2022. Appointed date is 1/4/2020. Appointed date is say 1/4/2022. Now there is a time gap of 2 years in between. Now the issue is to test the applicability of Section 72A conditions. Whether 1/4/2020, you have to test it from 1/4/2020, which is the appointed date, or from 1/4/2022, which is the effective date. One possible view, and which is supported by one tribunal decision, Delhi bench of the tribunal decision, is that since complying the principle of Marshall and Sons, which says that the amalgamation has to be given effect to from the appointed date, so therefore those conditions have to be tested from the appointed date and not the the effective date. But I may point out that this is an open issue in the sense that there are hardly any substantive decisions on this. Of course, there are few tribunal decisions which takes a view applying the Marshall Sons that those conditions have to be tested from the appointed date. Now, the fourth case study which I wanted to test was to delve with, as we all know, for the purpose of claiming the benefit of Section 112A. One of the condition is that the purchase as well as sale should happen on stock exchange, and the STT must be paid both at the time of purchase and at the time of sale. Now it may so happen that once the merger happens, at the time of merger, the original entity is amalgamating entity is an unlisted entity. So the shareholders of the amalgamating entity would obviously would have acquired the shares without payment of STT. Now, as a consequence of amalgamation, they may receive the shares of the amalgamated entity, which may be a listed entity, and subsequently they may sell the shares of the listed entity. Now, the issue which would arise is whether those shareholders of ABC, which was originally an unlisted entity, merged with PQR, which is a listed entity, whether they will be eligible for benefit under section 112A, despite the fact that STT was not paid by them at the time of acquisition of shares of the unlisted company. Now, one possible view, and in fact, and which seems to be the correct view, is that they will be eligible for the benefit, simply for the reason that if we see the notification which has been issued in the context of 112A, it only excludes some of the transactions which are basically tax avoidance transactions, wherein you acquire shares of entity which is very thinly traded, or which is in the nature of a penny stock, except for those cases, in almost all cases where you acquire the shares by way of an issuance of shares of an unlisted entity, so long as the shares of the listed entity are sold and the STT is being paid, then in that situation, the the benefit of 112A would be available in the hands of the shareholders of the amalgamated entity. Now, another issue which is arise is that in case of the parent holding WOS, that where, for example, ABC Limited is a wholly owned subsidiary of PQR, and ABC is amalgamated with PQR, and upon amalgamation, shares held by PQR were cancelled. Now, in that situation, whether the the conditions of 2(1)(b) are satisfied, according to us, this will be satisfied, because there will be, otherwise this will create a situation of impossibility of performance. Now, the another issue is where the as I pointed out, 72A versus 79. Another, in the 72A amalgamation may happen either by way of a normal course, where a scheme of amalgamation is filed and approved by NCLT. Another, the way of amalgamation would be, it may be part of the IBC process. Now, the IBC process may, for example, a resolution may specifically provide for amalgamation of the one entity into another entity. Maybe, say, for example, the corporate debtor into the company which has taken over the shares of the corporate debtor, or into any other company. So the issue which would arise is whether the conditions of section 72 are required to be fulfilled, and whether the benefit of those losses of the corporate debtor would be available in the hands of the amalgamated entity. So long as 72A conditions is met, so the answer would be the benefit would be available, irrespective of the mode of transfer, whether it is part of the IBC process or it is not part of the IBC process. But in case, in fact, but basically to supplement that, in case the scheme of the resolution plan specifically provide for something otherwise, as we know, because this resolution plan overrides these resolution plan approved by NCLT, overrides all other provisions, and they prevail over the other provisions. So in case resolution provides for any specific fulfillment of conditions or non-fulfillment of certain conditions, and that stands approved under the IBC, so if the certain conditions are dispensed with, then that would override section 72A. And despite non-fulfillment of some of the conditions which may be specifically there in 72A, one may possibly argue that the benefit of losses would be available in the hands of the amalgamated company of the corporate debtor. Another issue which in the context of 170A, and I think this is an important and an interesting issue, is as I provided that, as I said, that 170A specifically talks about filing of the modified return, and the assessing officer requiring to pass an assessment order to give effect to that modified return. The practical issue which usually arises in this context is the under which provision the assessment will happen and how the time limit will unfold. Now, just to give an example, now supposingly the scheme of amalgamation or the merger is approved on 9 September 2023, and the appointed date is 1/4/2019. Now, when the order of the the NCLT is received, there may be two situations. One, the assessments for 2020-21 and 21-22 may stood completed, and for 22-23 it may be pending, and the due date of completion is 31st March 2024. Now the issue arises is 170A specifically permits the assessee to file the modified return within 6 months. So from 9 September 2023, I will have 6 months to file my modified return. Now whether that 6 months period can be curtailed only because the limitation for passing of the assessment order is 31st March 2024. Because if we see section 153, there is no corresponding amendment in section 153 which extends the period of limitation for passing an assessment order in a case where a modified return is required to be filed under section 170 capital A. So this I think is a miss, probably a miss in the scheme, and probably the scheme, probably the Income Tax Act will require a modification in order to extend the limitation to give effect to these modified return. Presently, there are a couple of writs which have been filed in the Delhi High Court, and the Delhi High Court, considering this issue, has been pleased to stay the assessment proceedings, because the substantive issue which is being raised in those writs is then my substantive right to file a modified return over a period of 6 months cannot be curtailed by the provisions of section 153, which does not extend the limitation period. So that is one aspect. Another important aspect which may arise is what happens to my assessments for 2021 and 21-22, which already stood completed. Now 170A permits the assessing officer to pass an order. But how does he pass an order? Again, the law is silent on this. Probably section 170A, the assessing officer is required to pass an assessment order, modifying the assessment order if it exists, to take care of the scheme of amalgamation. The modalities is not there, but 170A is the only section. Or he will have to reopen the assessment under section 148 or 147 in order to bring to tax the incomes of the amalgamating company. So this is a larger issue, and on which the Income Tax Act is silent. Whether the assessing officer will pass an order in terms of section 170A itself, or he will have to reopen my assessments for earlier years in order to give effect to the scheme. So for example, in my example, for assessment at 2021 and 21-22, he may have to issue a 148. So these are open issues. I think there are no immediate answers to this, and I think the best course would be to make a representation to the tax department to clarify these issues, because reopening the old concluded assessment is more draconian, because then it may open a Pandora box on various other issues which may not be necessary to give effect to the amalgamation scheme. Another aspect which arises is, in a modified return, can I make a new additional claim which I may have missed out, either in the hands of the amalgamating company or in the hands of the amalgamated entity. The one prevailing one, according to us, if we see technically the provisions of section 170A, the law only permits the assessing officer to pass an order in conformity with the order of in accordance with the NCLT order or the order approving the scheme. And therefore, it may not be possible, hyper-technically speaking, to make an additional claim, because this is not an opportunity to make an additional claim, but only to file a modified return limited to the extent of giving effect to the business reorganization. But again, this is an open issue, whether those additional claims can or cannot be entertained. And then appellate proceedings, what happens to the appellate proceedings? I think those will continue as it is. There will be no effect, because those will cover the issues which arise in the original assessment order if there is an appeal against the original assessment order. And the assessing officer under 170A will only be passing order modifying the return to the extent of the modified return. But this is easier said than done, because on amalgamation there may be complex issues which may arise, which may have to be given effect to. There may be transactions which may have to be eliminated, etc., etc. I think those are all open issues which may require some clarification from the CBDT or some amendment in the provisions. Then, I think 56 to 7B was dealt with by Samir, so I'll not touch upon it. Section 32, we are all aware that, in case of amalgamation earlier, Smith Securities gave us the benefit of depreciation of goodwill. Now, goodwill depreciation is no longer available, but there may be other intangible assets which may get created as a result of amalgamation. And therefore, one can possibly take the benefit of depreciation on those assets if there are, actual intangible assets which gets created as a result of amalgamation. I think with this, I have come to the end of my presentation. I had to rush up because of the time constraints. I hope, I have been able to deal with the various important aspects. Thank you, everyone.
Thank you, Rohit. That was extremely good and useful. And you have taken us through all the relevant points and they are well noted. And though you've spoken at a brisk pace, but it's clear. So thank you. I'm also conscious that you and some of my other panelists have matters to now quickly proceed to for arguing tomorrow. So this is the end of the day. It's been interesting for us. I hope it's been more than interesting for the participants. We still have over 400 participants at the end of the day, and we had well over 500 towards the beginning and peak. So thank you, all of you. Thank you all who participated. Thank you, speakers. And I will now request Mr. Ikansh Gupta to formally give a vote of thanks, please. And then we take this to a close.
Hi, everyone. So on behalf of Direct Tax Committee of PhD, I extend my heartfelt appreciation to each one of you who has made this event a resounding success. Firstly, we express our sincere thanks to all our esteemed speakers for gracing us with their invaluable insight and knowledge. Their expertise and passion were evident throughout the session, leaving us enlightened and inspired. Our sincere thanks go to all our participants, both on YouTube and on Zoom, who joined us and were available with us for the entire session. We hope the knowledge gained today will prove to be beneficial for all of you. We extend our gratitude to our knowledge partners, our associate partners, and our online media partners for this webinar, whose unwavering support and belief in our vision made this webinar possible. Your contribution is instrumental in spreading the knowledge and fostering growth within our community. We look forward to meeting you all again in our future endeavors. Thank you so much.
Thank you all. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you, everyone.
Thank you.